First and foremost, a very warm welcome to all of you to this today's webinar. As a part of our webinar series, Deep Dives with IIQF experts. Today's webinar topic is Basel IV Framework Implications and Strategies. And our esteemed speaker for this session is Neha Mohta. So we are very glad to have you, Neha, with us. Thanks for joining. Right. So just to briefly introduce Neha, Neha has more than a career spanning of over 2 decades in the banking industry, and Neha has established herself as a subject matter expert in particularly in Basel regulatory implementations. Her extensive experience has equipped her with a deep understanding of the intricacies of risk management, capital requirements, and regulatory compliance. Neha's most recent area of work has been on Basel IV regulatory compliance for a Southeast Asian bank. So that's a brief introduction to Neha. Once again, thanks for joining. And before I hand over the session to Neha, maybe a quick guidance on how we would go about the session. As most of you know, this session would be total about 1.5 hours, in which in about 1 hour we would be speaking about the topic which Neha would be speaking on, and then post that we would have a Q&A. So since the participation is quite big, so unfortunately we would not be able to unmute you all, but please feel free to type in your questions or queries in the chat window, and we would try to take up each and every question, right? I would be modulating the questions, and we would be answering the questions or whatever you have. So please feel free to type in your questions, and we would like the session to be as interactive as possible, right? So with that, I would hand over the session to Neha. Neha, I'm making you the presenter. So whenever you are ready, now you can start the discussion.
Hi Nitish, I hope you can hear me okay. And can see my screen?
Yes, we can see your screen as well.
Okay, great. Can see the presentation, right? Okay.
Correct.
So my apologies. I'll be switching off the camera so that I can handle the tab as we walk through the presentation. Hopefully, I'm very excited. Actually, thanks Nitish for letting me do this webinar. Actually, I'm looking forward to share my understanding of the Basel IV reforms, have a discussion with so many esteemed people here, and try and collectively understand and walk through this maze of Basel regulations. Okay, Basel IV is very vast. Basel is very vast. The Basel regulations is very vast. For the purpose of our session today, we'll be focusing on the Basel IV, which is also known as Basel III reforms, Basel 3.1, and people unofficially term it as Basel IV. So, just so that we clarify at the start itself, there is nothing really termed as Basel IV. It's just that the Basel III reforms, which were introduced by BCBS, have been termed, commonly being termed as Basel IV. Okay, and we'll also try and understand why they are being termed as Basel IV. But before that, I've moved on to the next slide. We need to understand, what is this Basel reforms or Basel framework, or when I say Basel Accords that we are talking about. Okay, so just as a brief, I know we would be knowing, but just so that everyone is on an equal footing, Basel Accords are actually being determined by BCBS, which is your Basel Committee for Banking Standards. The objective of this committee is to come up with guidance, which sort of because we are in such a global environment, we operate in an international environment, correct, where there is hardly any boundaries between transactions, okay, and there is a bank will be in US, but you will be having a branch here, so you'll be actually banking with a bank which is originating in the US, correct? So because the borders are really very vague in terms of the economic borders are really very vague. So it is even more important for us to have a sort of a level playing field between the banks in all the countries or in all the jurisdictions, where which are following a similar set of reforms or similar set of regulations. Okay, so with this in mind, the BCBS came up with a series of over a period of time, they have been coming up with their Basel Accords. Okay, so the first Basel Accord came up with Basel I, which was in sometime in 1988. Now, the Basel I Accord focused on credit risk mostly. So, the focus of Basel I, it came up with what we know as the capital adequacy ratio, but the focus of this was more on credit risk. Okay. Then we had the Basel II reforms, which came up in 2004. We had Basel II, which came up in 2004. Okay. Now, the reason why there was a Basel II is because the industry went back to the Basel Committee and said that, the Basel I is really not enough. It does not capture risk correctly. It is very arbitrary. We think there needs to be revision. So you will see between 1988 to 2004, it took so long for us to come to Basel II. Okay, and with Basel II, you will see the screen below. There is a picture on the screen which is actually talking about the three pillars. So we came up with the concepts of three pillars, which is pillar one, the minimum capital requirement, which was essentially what was the only thing which is being covered in Basel I. Then we came up with a supervisory review process, and we came up with a pillar three, which is of market discipline. Okay, then happened the global financial crisis, sometime between 2007 to 2008. Though Basel II came up with this three-pillar approach, and it was very comprehensive in the sense that not only credit risk is being captured, for which we are trying to keep a minimum capital requirement, but we also had market risk and operational risk also being introduced for identifying your risk-weighted assets. Okay, that means my scope of the risk that I was trying to keep my capital for has increased from one single credit risk to now including market as well as operational risk. In addition to that, when computing your minimum capital requirement, previously the credit risk was a very simple formula in the sense that the risk weights were being given by regulator. If your counterparty is, say, a bank, then the regulator would have given a risk weight of 50. So you take this 50%, apply it to your exposure, and you can compute the risk weighted asset. It was pretty straightforward, okay? But it ignored the granularity in the sense that it was too standard. Okay, it did not have enough granularity to say that okay, a bank A and bank B can be different, though they are both banks, but they can be different based on the ratings, based on our dealings with them, based on many different criteria, based on the collateral they help to keep, etc. Okay, so there, or which region it operates, there can be lots of reasons for the differences. Okay, but the Basel I approach was very simplistic. Basel II gave us the gave us the option of, other than using the standardized approach, it gave us the option of using the foundation IRB, which is your internal rating based approach, or the advanced IRB, which is again an internal rating based approach, which we also call as using models for determining my PD, LGD, EAD, which are being used for the RWA computation. Okay, similarly for market risk, there was a standardized approach introduced as well as internal VAR models based approach introduced for your RWA computation. And for ops risk also, we can see that at least three different approaches were introduced to compute RWA for your operational risk. Okay, so though your Basel II came up with very, it would look like on the face of it that it actually came up with very good RWA computation approach across three different risk measures. Because of the global financial crisis, we found out that this is actually not enough. So, very common example that I keep giving during my liquidity sessions is, the scenario before the global financial crisis struck us was actually quite hunky-dory. Banks had very high capital ratios. The capital adequacy ratios, banks were actually quite flush. They were reporting the minimum required is 8%, but they were generally reporting like 10%, 15%, 20%, which is quite high numbers. Okay, so despite that, we did go through a financial crisis, and when we do an analysis, what Basel realized or BCBS realized is that a lot of papers actually have talked about it, that many things, though the ratio is the same, the capital adequacy ratio, but how it is being calculated between one bank to another is actually quite different. And it is quite different because banks are using internal modelings. It is quite different because the capital that the banks are actually holding are actually also quite different. Like someone might have a high equity capital, but someone might have a high additional tier one capital, and then finally, though the ratio is still 8%, okay, and they're meeting the minimum requirement. So the comparability across banks is actually not really there. And people actually lost trust in the credibility of the ratios which were being reported. Okay, so obviously because of all this feedback and because what was written by a lot of academic papers on the shortcomings in the comparability, not providing a level playing field for all the banks, and also the fact that, we are not really very resilient. We did not have a very resilient financial system. Basel, BCBS again went back to the drawing board and came up with the Basel III Basel III framework in 2010. Okay. This Basel III framework was further modified in 2017 for some additional information that is required to compute the risk very in a better manner. Okay, so what is the difference between Basel III and Basel III reforms that were introduced or Basel IV that was introduced in 2017? So Basel III, when it was introduced, it focused on the increase the level and quality of the capital. Okay, so I'm going to shift my screen a bit, and you will be seeing here the ratio. So when I talk about pillar 1, which is on capital adequacy, it is all about this ratio, correct? Your risk-based capital ratio, or the capital adequacy ratio, as we talk about, commonly know it as. Okay, so what do we have on the numerator? We have the regulatory capital. What do we have in the denominator? We have the risk-weighted assets. Okay, so the regulatory capital is generally what was the focus as part of your 2010 framework, which was introduced by Basel, okay, as part of Basel III. Okay, so basically, like it is mentioned, the level, so the quantity as well as the quality of capital was brought into question. Okay, so what, as a summary, what was the focus here? The CET1, or Common Equity Tier 1, that was brought into play, and it was said that CET1 should be at least 4.5%, and plus there was buffers which were introduced. Okay. Then the second thing, your 2010 Basel III focused on was enhance the risk capture. When we say enhanced risk capture, the focus here is on the denominator. Okay, denominator, which is nothing but your RWA. Okay, so you will see the capital requirements for market risk. So if you are aware of FRTB, okay, so how capital, previously we saw as part of Basel II, we had the standardized approach and the internal models and VAR, which is based on VAR, okay, but with in 2010, Basel came up with the FRTB requirements, which is more sensitivity based, okay, in capturing market risk. Okay, also a lot of focus also came in counterparty credit risk assessment. Okay, so the actual exposure when we compute what is the exposure because of counterparty credit risk, okay, for derivatives transactions. Okay, that was brought into play also as part of the denominator related enhancements which were being done as part of Basel III. Okay. Quickly, leverage ratio was something that was also introduced as part of Basel III, and my bread and butter for the longest time, liquidity ratios like your LCR, NSFR was also introduced as part of your Basel III. Basel III also introduced CCYB or counter cyclical buffer requirements, which is again adding on to the capital. It also introduced capital conservation buffer as well. Okay, so Basel III in 2010 itself had a whole list of enhancements that were introduced. But in 2017, there were still more revisions which were made. Okay, and you will see most of the revisions are coming in for your denominator, which is enhanced risk capture. Okay, so what was enhanced as part of this? We'll see there was a standardized approach to calculating credit risk. This will be the focus of our discussion over the next few slides. Okay, we will see how Basel enhanced as part of the Basel III reforms, how it enhanced the standardized approach for credit risk, and why does it take so long to come up with the enhancement, to agree on this enhancement, and for banks to implement this. Basel III reforms have not yet been implemented in many countries. Okay, so why is it taking so long? So we'll talk about this part quite a lot during our session today. Okay. Also, another key aspect of the reform has been an output floor introduction. So the output floor was also there previously, but now the output floor is quite enhanced. So we'll focus on, how is the output floor impacting the RWA computation. Okay. So this was to give a preview on what we'll be discussing about. The Basel IV 2017 reforms seek to restore credibility in the calculation of risk-weighted assets and improve comparability. So because we are trying to focus a lot on standardized, and if everybody is following standardized approach for computation, we will increase comparability between a bank A and a bank B. Okay, and because we are trying to again implement standardize or focus more on standardized usage for computation, we are trying to say that yes, everybody is computing using the same or similar method, is computing RWA using similar methodology. Okay. So because a lot of our discussion is going to be on the SACR or the standardized approach for credit risk, it is important for us to get an understanding of a simplistic calculation. Okay, so for how do we do a simple RWA assessment on any given exposure? Okay, so the first thing is what we have to determine. What is the first input that we need to determine credit risk RWA using the standardized method? we need to know what is the exposure amount. Okay, what is the exposure amount? If bank A has given a loan to you for rupees 100, that 100 is nothing but the exposure amount, the amount of loan that the bank has given. Okay, so very simplistic explanation. So this is the exposure amount. Step 2 is to determine whether it is an on balance sheet exposure or is it an off balance sheet exposure. Okay, so when you go for a home loan, okay, the loan given to you is for say 200 rupees. Okay, the loan given to you is for 200 rupees, but out of this 200 rupees you have only drawn, oops, you have only drawn on 50. Okay, this is the, sorry, this is the total loan that the bank has agreed it will pay, that you can take as a home loan, out of which the amount that has been drawn by you is 50. This is the drawn amount. That means this is the amount that you have already paid to the builder. The remaining 150 is undrawn. That means you have not really taken the loan from the bank as yet. Okay, but you all have agreed that yes, if you want, you can take this amount. Okay, so this is the undrawn part. Okay, now your drawn is nothing but on balance sheet because you have actually done the transaction, and the undrawn is nothing but off balance sheet because you have not yet done the transaction. Okay, you have not yet taken the loan, you have only agreed to take the loan of this remaining amount. Okay, so there can be a chance that out of this 150 you might draw the full amount, you might draw only part of the amount because you want to maybe use some of your own funds, or in some cases like when we look at market securitizations or something, the CCF is much more. Okay, so basically how much of this undrawn amount will be actually converted on balance sheet is nothing but the CCF, or the credit conversion factor. Okay, so if it is an off balance sheet exposure, then I'll need to use the CCF. So in my case, let's say I know this entire 150 is going to be drawn one day. So my CCF is 1. Okay, and my on balance sheet is already 50. So my exposure, or my my EAD till this time becomes 200. Okay, or my exposure becomes 200. Okay, before I compute the EAD, I also need to know whether my exposure is secured or unsecured. Okay, if it is secured, that means there is a collateral. I will be actually able to reduce the amount, okay, that I have as an exposure. The bank will actually be able to reduce the amount that they have computed as an exposure because they have some collateral, and that collateral needs to be eligible. So there is a lot of requirement on the eligibility. Okay, but if it is unsecured, that means my entire 200 is going to be a EAD. Okay, so once I have computed EAD, in this case, let's just take it as 200. Whatever is the risk weight which has been prescribed by the government, by the BCBS, is something that I will be considering. Let's say if my asset class is something like retail, individual, okay, and for my asset class, I have a 10% risk weight. Okay, so the RWA computed is actually going to be 20. Okay, so this means for this 20, I as a bank need to put in some capital which is going to be equivalent to 8%. Okay, so with this understanding of the computation of RWA for standardized approach, let us look at what were the changes which were introduced as part of the Basel IV or the Basel III reforms. Okay. Now, as part of the Basel III reforms, the focus has been to provide a competent global regulatory framework. correct, and to improve the comparability. So they have focused, Basel has focused a lot on enhancing the risk sensitivity of the standardized approach. Okay. And it has tried to, like we discussed earlier, it has also tried to constrain the internal rating models. Okay. So what Basel has also tried to do is put an onus on the organizations on credit risk assessment that they are carrying out. Okay. Now, for organizations, for say an exposure to another bank, okay, generally they would rely on the credit ratings which are available for those banks to determine the riskiness. Okay. So if you see this table here on the slide, generally when giving the risk weight for banks, you have this option of, okay, what is the risk? You can see these are nothing but the credit ratings, AAA to AA minus, A plus to A minus. All of these are nothing but credit ratings. Okay. So based on the credit ratings, better the credit ratings, lower the risk weight. If lower the risk weight means lower the RWA and hence lesser the capital required for that particular exposure. Correct? So you'll see lower the risk weight is better, right? So in our case, we can already see that for banks, till now, we have been doing the risk weighting based on what has been given by the external credit agencies. But not all exposures are going to have ratings. Not all banks are going to have ratings. We have who gives us credit ratings. We have big agencies like S&P, Moody's, Fitch. Then there are a lot of other local agencies that will give credit ratings for banks, okay, or for corporates, or we are talking about more corporates and banks exposure here. Okay. So for the bigger companies, generally there will be an IIQF or external credit rating assessment available. Okay. But not for all. Maybe for smaller banks, it might not be there. Okay. So the banks are generally in that category is known as unrated. Okay. Now for these unrated banks, rather than just giving them some risk weight of say 100%, okay, because they are unrated, then they need to be given some risk weight percent. The BCBS is asking us to do an impact assessment to identify what would be the to do a standardized credit risk assessment for the banks. Okay, so if it is an unrated bank, the onus is on um, the bank. Okay, so when I say unrated bank as a counterparty, then the onus is on the bank. Say I am the bank. It is on me to do the standardized credit risk assessment for the banks who are my counterparty, and then based on the my credit risk assessment, whatever is the grade that I slot this unrated exposure into, I will be able to use the specific risk weight. Okay. Now, why is this something that we are talking about? Okay. Why are we talking about this? It seems simple, right? Oh, yeah. Unrated exposure, then you do internally, you do some sort of assessment, and then you slot it, and then you use a particular risk weight as provided by the regulation. But it's not as simple, because the banks have to develop a process or a mechanism for doing this credit assessment, okay, this additional credit risk assessment, which previously they have not been doing. Okay, so the introduction of SCRA has a bigger implication, in the sense that bank, when dealing with a bank counterparty, also have to additionally do their SCRA, or standardized credit risk assessment, so that if it is an unrated bank, they can use the SCRA approach for for identifying which risk weight is suitable for the particular bank. Okay. Now, if this was not there, like we would have seen in previous regulation, the unrated would have gotten, say, a flat 100% or an 80%. But because of your assessment, because of looking at more indicators like the capital ratio of the particular bank that you are assessing, or the leverage ratio of that particular bank that you are assessing, by looking at different indicators which have been prescribed as part of the SCRA, you are able to now get a more granular risk weight, and you can distinguish a bank A and bank B, though both of them are unrated, okay, in terms of riskiness. Okay. So continuing with this theme, for rated banks and general corporate exposures, BCBS introduced the process of due diligence. See, what is the implication of what we are talking about here? Business or banks have to rewrite their process for onboarding customers. Okay, they need to do all of this. They need to have all of these additional governance included as part of their assessment for a customer. Okay, a risk assessment for a customer. Okay, so again, the whole point of doing due diligence is that despite having ratings from credit rating agencies, the relationship managers, while doing the credit origination for a particular bank or a corporate, they might have ratings from external credit rating agencies, but we ourselves have to do a proper due diligence process on whether these ratings are really applicable, or do we think that I would actually rate them lower than the ratings that have been given. Okay, so the idea is to be more conservative. External is telling, yes, this bank is going to be A plus, but you, basis on your investigations and on the information that you have, think that no, this bank is actually a B plus. That means it is a higher risk weight. It deserves a higher risk weight than what has been suggested by the external credit rating agencies. Okay, so this is the process that BCBS has asked for banks to carry out compulsorily. That means they have to do a due diligence on the ratings that are being assigned to any counterparty, a bank or a general corporate exposure only, not all counterparties. Okay, so why we are doing this? So that we are not reliant solely on external credit rating agencies, and we are putting in a process for independent credit rating assessment, right? We also know this scene from the 2008 crisis, right? There was a whole paper that came out, which is like, the issuer or the counterparty pays to the credit rating agency to give them a rating. Okay, so basically, the credit rating agency, like say S&P or Moody's, is rating any particular counterparty. They are being paid by the counterparty themselves to do their credit rating assessment, which actually, seems incorrect. Obviously, when they publish a rating, they give the complete background methodology behind why a particular rating has been assigned. But still, because, the rating giver, the rating provider is actually giving the rating to the same counterparty from which he is receiving the money for. So to have that wall added, regulators are saying that you yourself do a due diligence. Don't rely on the external rating solely, okay, for your assessment of the counterparty risk. Okay. I'll move on to the next slide, which is actually talking about one of the major changes that we have seen as part of your standardized approach to credit risk, which is your exposure to real estates. Okay. Now, when we started with this session, the example that I took was that of a home loan. Correct. Now, the whole purpose, again, I'll keep on reminding, of Basel IV was to bring in additional risk sensitivity. Correct. That means if it needs to distinguish as much as possible a risky exposure from a relatively less risky exposure or a relatively more risky exposure, so that different risk weights can be assigned to them. Okay, so for doing this increased sensitivity, they have started using a lot of different data points. Okay, so previously risk sensitivity was being assigned based on what is the type of counterparty, very broadly speaking. If it is a bank, 10%, if it's a corporate, 30%, if it's an individual, 5%, very generic risk, very generic risk sensitivity assignment, okay, or risk weight assignment, okay. But the whole point of Basel IV is to increase the risk sensitivity. So they are now using additional data points to identify what is the actual riskiness of an exposure. Okay, so for real estate exposures, more data points like what is the LTV of a particular exposure, okay, of the collateral which is assigned to a particular exposure. Okay, what is the collateral that is being given to us? Is it an income producing real estate? Okay, the exposure that, the home loan that I have taken on, am I putting the flat on rent? Or if the loan that I have taken for is to make a mall, how do I plan to repay the loan? Do I plan to repay the loan from the earnings that I earn out of the rents for the shops that are there in the mall? Okay, so this is the meaning of income producing real estate. That means, is the real estate having any rentals? Okay, are you using those rentals to pay the EMI to the bank? Okay, so, and also, does the real estate meet operational requirements? Okay, is the documentation that was received for the particular collateral complete? Is the property itself under construction, or is it completed? And there are other operational requirements. So let's see how this all plays out in terms of assigning different level of granularity. Okay, so if it is a residential real estate means what? If it is somewhere that I am staying as a home, okay, it can be a flat, villa, a bungalow somewhere, okay. But this is a residential real estate. It is for the purpose of people living, okay. If it is we'll look at what is the LTV associated, or the loan to value ratio which is associated with regards to that exposure and the underlying collateral. You know what is the loan to value ratio? Your loan to value. The loan is the exposure amount and the value is the property value, which is the collateral for that exposure. Okay. So generally, a lower loan to value means that in case I default for paying the loan, I do not pay the loan, what will the bank do? The bank will sell the property and they will ensure that the loan amount is returned back to them. Okay, so the bank will sell the property and they will get the loan amount back. Okay, so that's the purpose of LTV. Higher LTV means that my loan is actually very, like an LTV of say 120%. What is it indicating? That even if I sell the property, I will not be able to repay back the loan, or I as a bank will not be able to get back that amount that I have given as a loan to person X. Okay, a lower LTV of say 20% is actually saying that yes, the property collateral is a very good collateral. If I sell it, then I will actually be able to recover the amount that I have paid as the loan. Okay, so lower LTV, less risk, higher LTV, more risk. Okay, so that's what you will see reflected here. So how we had for banks and corps, that we were actually looking at the credit. I'll go back to the slide. We're actually looking at the credit ratings to identify how risky the bank or the corp is. Okay, but for real estate exposures, we are looking at what is the type of the real estate. Is it residential or commercial real estate like malls, hospitals, etc., or is it residential real estate like like housing societies. Okay, so and then what is the LTV band associated? Okay, so we can see if it is an LTV band of 20%, then the risk weight assigned is, if the LTV is below 50%, the risk weight assigned is to be 20%. If the LTV is above 100%, the risk weight actually assigned is 70%. Okay, but now let's just go to the other part, the other granularity that we are talking about. Is it an income producing real estate, which means are we relying on using the rent that we have received from that particular real estate to repay back the loan? Okay, so if it is an income producing real estate, but the LTV is still 50%, you will see it has still been given a higher risk weight when I compare to a non-income producing real estate. Okay, what is the risk here? Suppose if the rental market goes down and the flat is not out on rent, will you be able to repay the EMI that is due to me? Correct, that is something that banks need to account for. Okay, and hence they have also started looking at this criteria as given by the BCBS guidance to look at whether a property is income producing or not as well. If it is income producing, more risk weight has to be assigned to them. Okay, now why does it matter? Again, you would say, oh, simple, it's just additional data granularity. So before Basel IV said that yes, we want you to classify based on whether a property is income producing or not. Banks may or may not have had that information. They were not going on asking that, oh, are you going to give the property on rent? What is the expected rental value that you get every month on the property on which I have given you the loan on? Okay, nobody asked these questions, or they would have, but it was not mandatory. Now this is actually mandatory for us to capture. Is there any income associated to the collateral? Okay, so if there is any income, then obviously we have to account for this and give it a higher risk weight. Okay, so to do this type of change, now just try and imagine. Okay, it is not that the information is there in the banking systems and we have to get this. We have to start capturing this information in the banking system. Now, whether there is any rental income associated to this particular exposure, facility, and related collateral. Okay, so all this sort of information needs to be captured by banks almost from the scratch, unless they have already been doing it. Previously, it was not mandatory. Now it is mandatory because it's being used for the standardized approach computation. Okay. Very briefly, same thing for commercial real estates. We can see commercial real estates are also using the concept of LTV, and but you will see commercial real estates have a higher risk weight. Okay, look at the risk weight of 20% or 25% for less than 50 to 60 for a residential real estate exposure versus a commercial real estate exposure where the risk weight which is being assigned is 60%. Okay, so why is that the case? Is obviously commercial real estates they are more prone to variability, more prone to riskiness versus the residential real estate, which is what is being also showcased in the risk weight assignment. Okay. So that was, we can see that how SACR as part of Basel IV is looking at more granular data. Same is reflected for retail exposures. Okay, what are retail exposures? Like you and me going to the bank for any transaction, any loan. We are retail customers. So these are retail exposures. Okay, so the main one of the more challenging concepts which was introduced as part of Basel IV in terms of implementation has been the concept of identifying whether a retail exposure is a transactor or a revolver. Okay, now what is this classification? So basically applicable for your credit cards and overdraft related exposures, we actually want to see um, who is actually using credit cards and overdrafts as a regular source of loan versus using credit cards or overdraft as a source of transaction. Okay, so if I have taken if I have taken um, I have used my credit card last month, okay, and I am said that this month I have to make a payment of rupees 100 to the credit card company, okay, and the minimum due is 20, okay. Now, because I am short of cash, I pay rupees 20 minimum due, okay. I don't pay the full amount of rupees 100. Don't you think, for a bank point of view, I should be tagged as someone with some higher risk than someone who would clear their monthly dues every month? I think yes. So that was the reason why this concept of transactors and revolvers was being introduced, so that those who use credit cards or overdraft as a source of loan, that means from one month to the other, they are not clearing off their balances, their due amount, then they would be classified as revolvers, and a higher risk weight is given to the revolvers. Okay. Now, why this has been so challenging to implement is because this is very data intensive. Okay. Your regulations ask you to look at least 12 months of history to see that has the customer in any given month, acted as a revolver. If yes, then he needs to be tagged as a revolver, even though he acted as a revolver 11 months before. Okay. So here, actually, when you're doing the internal, when you're doing modeling and all, where you need all this information, but prior to Basel IV, for standardized approach computation, we really never needed so much of information, so much of historical data to determine the credit risk associated. Okay, so they are actually trying to give us enough granularity, enough data points so that we can make an informed decision here. Okay, one of the bigger changes that was also made, which is actually going to have an implication on the bank business model, okay, is CCFs for off-balance sheet items. Okay, so remember, let's go to a credit card example. So when we take a credit card, okay, by default, they will give you a limit, okay, like saying that, oh, you can use up to, let's say, 1 lakh. You can withdraw or you can do transactions up to rupees 1 lakh. Okay, this you might use say only rupees 100 in a month, you might use only rupees 10,000 in a month in terms of actually doing a card transaction, you might use say rupees 1 lakh entirely. Okay, so basically this again is nothing but a limit which is given when a card has been issued. Okay, and this is nothing but the drawdowns, or the amount that you have actually drawn or taken as a loan from that credit card transaction. Okay, when you do a credit card transaction, you are actually taking a loan for a small period of time, correct? So this is actually something that you have drawn from a limit of rupees 1 lakh. Okay, we said CCF is applicable for off balance sheet items per our earlier discussion. Okay, so CCFs applicable for off balance sheet items. Previously, for credit cards, this commitment is of this facility of rupees 1 lakh, you didn't ask for it, right? The banks just gave you, when giving a card, oh, this is the facility, you can do transactions up to this. You never asked them. In very few cases it is like, oh, but I need a limit which is high, can you do that for me, when we go for a credit card application. But generally, whatever limit they give by default, we are okay, right? So now what is going to happen? Previously, before Basel IV reforms, Basel III reforms, this credit card limit or the undrawn portion of the limit. So if I have withdrawn 10,000, my undrawn portion is 90,000. Okay, this 90,000 is off balance sheet, correct? Because it is undrawn. Okay, on this 90,000, previously a CCF would have been applied, which was of 0%. That means my EAD on this amount is actually 0, which means there is 0 RWA. Correct? You all are with me? But now they have changed this to 10%. So as part of your Basel IV, the CCF, which is for such type of limits that have been made, which are also conditionally cancelable commitments, okay, has now been increased from 0% to 10%. That means if I have a credit card with a limit of rupees 1 lakh, on the undrawn portion as well, now I have to ensure that I have a capital to cover for this undrawn portion of the uncommitted facility as well. Okay, so immediately now imagine all our banks who are doing credit cards, okay, they have to account for this change in CCF requirement. Why? Because this is going to impact on your RWA, increase the RWA, and obviously increase the capital required. Okay, so in terms of SACR, these are some of the key changes that we are talking about, which we can see have actually there have been they are going to impact the business model. They are going to impact the business. Banks need to do an assessment of, okay, which is the profitable business, how much limits they need to give for previous where they were giving for unconditionally cancelable commitments, what would be the revised limits that they need to give. Okay, how do they have collect the data so that they can do the decisioning of whether a particular customer will he belong to a transactor or a revolver category. Okay, so very data intensive and also have impacts on the business associated business model. Okay, there have been few changes which are also on the internal rating based approach. Till now, we were talking about the changes that were made on the standardized approach. Now we also have changes on the IRB approach as well. So what has essentially changed? What is IRB? To give one brief example, because we have few slides to cover. Okay, what is the inputs to compute IRB? Okay, let's say AIRB or Advanced Internal Rating Based Approach and FIRB. What are the inputs which are required from the bank? Okay, remember for credit risk, the input is given for standardized approach. The input in terms of the risk weight to use is given by the regulators. For IRB or internal rating based approach, we can do the computation. Okay, so we can give the inputs. So the inputs that we actually need are PD, LGD, EAD, and then you have maturity, and then there is a capital computation or K factor, okay, which is more formula based, okay, but these are your real inputs which are given. For FIRB, the only input which is required or is used from a bank point of view is the PD, okay, but for AIRB, PD, LGD, EAD, all three can be provided or used as generated by the bank's internal models, okay. Now, so what has happened? My internal model is suppose generating a PD of 4% for let's say real estate, not real estate, let's say some retail exposure, okay, for a retail asset class, it is generating a PD of 4%, okay. But as part of Basel IV, they have come up with a PD floor. Okay, what is the purpose of a floor? The floor has to be the minimum. Okay. Now, generally, your computation, how your PD LGD is used, PD LGD into EAD is going to give you expected loss, correct? And then your expected loss plus unexpected loss is going to be your RWA. Okay, so if your PD increases, your expected loss is going to increase. Your LGD increases, your expected loss is going to increase. One of the factors increases in these three, your expected loss is obviously going to increase, and hence your final RWA is also going to increase. Okay, so till now, banks were using what has been the computed model. If it is a bank on advanced approach and they generate a PD of 4%, they would have used a PD of 4% for that particular exposure. But now with the introduction of PD floor, the regulator is specifying what is the minimum PD that you should use. So in this case, suppose the regulator has specified a PD of 5%. That means though my internal model is calculating 4%, I can only use 5% for computing in this formula. Okay. So again, by putting in some floors for IRB also, they are trying to do some sort of a level playing field approach here. Okay. I just need to move on to maybe operational risk. I'll not cover so much in detail because I need to talk a bit more about output flow before I hand over to Nitish for the Q&As. Okay. Okay, so operational risk, there has been a major overhaul in terms of Basel III versus Basel II versus the Basel III reforms. Okay, so operational risk, if I go back to the first slide that we saw, as part of Basel II, we had three approaches to compute operational risk. Okay, and if I go to the next slide, I have changed to the slide which is from BCBS, which generally states, okay, your risk-weighted assets are majorly consisting of credit risk, and the next biggest risk which is there is actually of operational risk. Okay, so operational risk needs to be computed and needs to be computed uh, in a scientific manner, okay, which is what they have tried to attempt with the changes that they introduced as part of operational risk in Basel IV. Okay, so previously operational risk, we had basic indicator approach, we had a standardized approach, and we also had a internal models based approach for computing operational risk. Now we have moved only to one single standardized method. Okay, and this standardized method is actually quite intensive because it needs 10 years of operational loss events data for computing operational risk. Okay, there are some assumptions that the model, the formula also makes, is that it is assuming a bigger bank will be subjected to a higher operational risk, because bigger the bank, it can be subjected to many different operational risk events. Okay, and it also assumes that banks with high historical operational risk losses are expected to experience the same in the future. Okay, so they have the simple ops risk formula that is introduced right now. There is a business indicator component, which is nothing but the measure of the income of the bank, and you have an internal loss multiplier, which is basically which captures the bank's own internal losses. What is the risk sensitivity, or the factor which captures the risk sensitivity of the bank's own internal losses? Okay, so standardized method introduced because to increase the comparability, but it is subject to data gaps because we need 10 years of operational loss data, and operational loss really started getting captured only recently, post the global financial crisis was when it started gaining a lot of momentum. Okay, and till now it is evolving. Okay, so to get this much of information and to use it for reporting for operational risk is going to be put in the framework within a bank to capture, measure operational loss events is something that is going to need a lot of investment and focus on. Okay, so now let's come to the most important point that we need to discuss as part of the Basel IV, Basel III reforms, okay, which is the introduction of the output floor. What is the output floor? Now, generally, a bank will compute their RWA based on a nominated approach. This nominated approach can be a mix of your standardized approach, AIRB, FIRB, right? Because not all portfolios of a bank are following one single approach. Okay, banks receive portfolio-based approvals on what approach they can use. Okay, so by default is the standardized if you have no approvals, but if you want to use internal models, then you have to go to the regulator for an approval. Okay, that can I use advanced approach when measuring for banks, asset class? Can I use foundation approach when measuring for specialized lending? Okay, so different portfolios can be given different approaches, can compute RWA using different approaches. Okay, so there will be a nominated approach which can be a mix of your standardized AIRB or FIRB, and then there is a standardized approach. Okay, as part of the Basel IV requirement, you need to always compute using the standardized approach and as well as your nominated approach. So till now we were only computing using nominated approach, but as part of Basel IV we also have to compute using the standardized approach. So this entire computation is additional. Okay, in cases where I'm already using my standardized approach, like if you see in this case, my market risk and my ops risk only has standardized approach. That's why it is same. The values are the same. Market risk, I am using for the purpose of my example, standardized approach, hence the values are the same. But for credit risk, I can see that maybe I'm using a lot of IRB approach, hence the values that I use computing nominated approach versus standardized are different. Okay, so if I was to compute my denominator of the capital adequacy ratio, which is the total RWA, if I was to use the nominated approach, it comes to 260. But if I was to using the output floor approach, using the standardized approach, which is the total of 700, 550 and 10, which is 760 into a factor. This factor is being provided by BCBS in terms of the transitionary percentage to be applied over a period of time. Okay, so it's not 100%. It is, say, the last one that they have prescribed is 72.5. Okay, so if I use this factor, then the RWA that I'm expected to keep is 551. Okay, now what the output floor is saying, it is saying that my RWA has to be the greater amongst the two. So between 260 and 551, the RWA that I need to report is 551. Okay, and I need to keep the capital based on this RWA of 551. What are the implications of this? Obviously, using I will be using the standardized. The standardized needs to be used, approach needs to be used as the RWA. Why? Because my nominated is less. If my nominated was higher, if it was greater than 551, then I would have used the nominated. So basically, the regulation is asking us to use the more conservative of the RWA. Okay, if your nominated is already very conservative, then good, but if it is not, then you need to start using the standardized. Okay, it also means that your internal models related benefits are restricted. The whole point of internal models that the banks, actually aimed for was to get to reduce the capital requirement, because they could say that, oh, see, using all the modeled data and the back testing on that data, I can prove that my capital requirement is only 100. Okay, so they go to the banks, they go to the regulators, they take the approvals. Okay, so internal models are actually beneficial because they help to optimize the capital that is required, because they help to also optimize the RWA. Okay, but this benefit is now gone because I am always doing a comparison with the standardized approach. Okay, banks will always have to compute using the standardized method as part of the Basel III reforms. Okay, they will also have to report. Certain reports are also there, even if you are computing your capital based on standardized or nominated approach, because till now it is higher. You still have to do the reporting, uh, including the standardized approach as well. Okay, and obviously, because we are now looking at, we see that more standardized approach will be used in the future. We are looking at improved comparability, correct? Because now we know all banks are using standardized approach for their RWA computation. So basically, just to what we have discussed as an example, just putting it to a graph, okay? With my standardized approach, the RWA computed was that of 100. With my internal models, the RWA computed is that of 60. My output floor is saying that I need to, I need to compare my internal model, which is 60, to a factor, in this case 72.5, of 5% of your overall standardized approach, which was 100. So 100 into 72.5. So I'm comparing 72.5 versus 60, and I know that now I have additional capital requirement for the additional RWA, okay, which is 72.5 minus 60. So this output floor, these are Basel IV BCBS timelines. Okay, BCBS timelines are generally applicable for the GSIBs. For all the other banks and all the other countries, generally what happens once BCBS comes up with guidance, they have to, all the countries have to implement these. Okay, so the guidance will go to every country, will take those guidance. Every regulator from the country, like RBI in our case, in India, MAS, ECB for European banks. Okay, they will take those guidance and they will take out a regulation which needs to be, go to parliament and get the sign. The bill will be passed, and then the rules are implemented for the particular country. Okay, so the timelines which are given here for your Basel IV output floor, you can see, are actually starting from 2022, where you say that we need an output floor of 50%, to ending in 2027. Okay, which is 72.5%. For countries who have not yet started implementing Basel IV, it will probably be delayed by a few years. Okay. So what is the impact of the output floor? How does it impact the bank's strategies or decision making, or how does it generally impact a bank? Okay. If your RWA increases with the Basel III reform implementation, banks will obviously need to consider which is a riskier asset class, identify what is the riskier asset class, and try to reduce their exposures. Okay, what we also said, exit the unprofitable. Okay, they will also have to do better limit management, for what we saw as an example on limits which are given for credit cards. Okay, they need to be better managed now, because now they attract additional credit conversion factor and hence additional RWA. Okay, there will obviously now, because we are looking at RWA increasing. RWA increase means what? That the related capital is increasing. If we say capital is increasing, the capital will not just increase like this. Bank has to go in the market, it has to raise the money. Okay, and we already know that equity is the most expensive source of funds for a bank, correct? Like compared to a debt or something, equity is the most expensive source of funds for a bank. Okay, so um, uh, because we now need more capital, we are also we are also engaging in additional cost of doing business. Okay, so if I still want to continue giving loans to commercial real estates, RWA and need more capital, then obviously if I was charging an interest rate of 15% from the customers, I will have to see how I can reduce it, I can increase it to more, so that charge additional capital that I need for providing a product back to the customer. Okay, or the other way is I reduce the profitability of the bank. Either I pass on the cost to the customer, reduce the number of customers, or I reduce my profitability. Okay. There is also the concept of the fact that if you raise additional capital, you now have more shareholders. That means your earnings have not increased, or your earnings are still the same, but your capital has now increased. So obviously you're diluting the return on equity, okay, or the dividend repayments that the dividend payments that you'll be making to the customers. Okay, some other factors that banks will need to consider is on the quality of collateralization, how they can benefit from collateralization to reduce their exposures, how they can optimize their product offering, and how they can improve data quality. Why do we say improve data quality? Because if we suppose, generally what banks do, if they don't have a particular data point available, they go with the most conservative and say that, oh, we go with the more conservative approach, which is generally resulting in a higher RWA. Okay, higher RWA, higher capital. So banks really now need to focus on collecting data, storing data, processing the data, because this also is going to impact on the RWA computations. Okay, that was it from my side. That was what were the key points that I wanted to cover for Basel IV. Nitish, over to you for any questions that we have.
Yes, we do have a lot of questions actually. Some of the questions, of course, were I mean, follow up on some of the topics that we have that you have discussed. So, I mean, we'll take it one by one. But before going into the questions, first of all, yeah, I mean, it was a very engrossing session, and maybe just to give you a 2-3 minutes breather also before we go to the Q&A. I mean, I'll just
Thanks.
well, I'll just like maybe talk about a little bit of the work that we have been doing at IIQF, and then we will go into the Q&A. Right. So, I mean, yeah, I mean, in fact, actually, like again, Basel IV is, or Basel in general is such a huge topic. I mean, it was I mean, you have summarized it quite well. Of course, again, in our own courses, actually, we get more chance to discuss this in more detail. But still, I mean, I mean, in about an hour, you have summarized it very well. Before going into the Q&A, just very briefly to give Neha a little breather, and also to maybe but just to summarize the work that we have been doing all this while in this field, right, for the last 1.5 decades. So, as most of you know by now, I mean, I represent Indian Institute of Quantitative Finance, which is one of which is considered the oldest and the leading quant education body in India, and we have been tirelessly promoting quant and financial engineering, risk management, quant algo trading, and artificial intelligence and machine learning related education in India. And we are have been founded by pioneers and top experts from the field of financial risk management, financial engineering, and investment banking. And I mean, this is what we have been doing for 1.5 decades. So people who want to make a career in this particular field of quant or related areas of financial engineering or risk management, I mean, they generally go through the comprehensive courses that we have for both professionals as well as students, right? Majorly, I mean, which are done through online, live, and interactive lectures on the weekends. So, I mean, people who are interested in risk management or quantitative analytics areas of finance. So for them, there are two courses that we do. One is a course called Certificate Program in Financial Engineering, which is very mathematically intense course teaching all aspects of quantitative modeling for valuation and pricing of derivatives, going into major areas of risk management like market risk, credit risk, and operational risk, both the theory plus actual modeling and implementations in Python, right? It's a 7 months weekend program. And then we have another course in the same discipline, a little less quant heavy course called Quantitative Finance and Risk Management, which again teaches all the derivative valuation and pricing models in deep. And also in this quantitative finance and risk management course, the risk management segment is more deeper and more involved than the financial engineering program. So these are two courses for people who want to specialize in quant, finance, financial engineering, and risk management. If somebody wants to specialize in algorithmic trading, then we have a very comprehensive course called Postgraduate Program in Algorithmic Trading, which is 8 months. Teaches end-to-end all aspects of algo trading using technical analysis, price action, machine learning-based strategies, and other quant model-based strategies. And then now we have specialized programs in data science and ML applications in finance. The comprehensive course called AI for Finance, covering all aspects of machine learning models in finance, data science models in finance, and somebody doing the AI for Finance course, they can also do a specialization in AI for derivative valuation, AI in risk management, AI in trading, and AI applications, or generative AI in finance as well, right? So if somebody is interested in the risk side and understanding the machine learning aspects of risk or derivative valuation or quant or trading or generative AI, they can actually go through these courses. If somebody wants to make a career as an AI or ML expert or data scientist in the financial aspects, right? There are some super specialization short modules as well. As I was mentioning, these are specializations which can be done as separate certificate programs. So somebody having exposure, already having exposure to machine learning and data science basic knowledge, they can do these programs where we do deep dive into the super applications of AI in different areas of finance. So somebody can specialize in AI for derivative valuation, AI for risk management, AI for trading, and you have a module on generative AI of finance. So depending on one's interest, one can actually go through this as well. All right, so not delving much into this. These are some of the students, professionals particularly, who have gone through our courses and have made good careers. So essentially, you can, I mean, just for you to understand, I mean, how people have utilized our courses to make wonderful career in quant risk and related trading and related areas, right? So when you can go to our website testimonial pages as well to go through their testimonials to understand, not to for advertisement, but again more for you to understand how these courses can be utilized to make a career, or even if you're somebody who is already working in this field, how to actually go deeper in terms of both theory and modeling, right? And for people who come to us, there is a strong placement support after the courses. I mean, and the support system starts at the onset. I mean, from the time you inquire with us. I mean, we evaluate, we discuss with you, evaluate your overall background, and then suggest the right course. It starts from that part, actually, the career counseling part. Then, of course, during the course and after the course, there are career mentorship by industry experts. All courses are invariably taught by people who have stellar experience in the industry in leadership positions, I mean, and each subject is taught by an industry leader in that particular who has worked in like the modeling space in that area. So, for example, Neha, who has been working in Basel and liquidity risk areas, I mean, she teaches for us the liquidity risk model. So, similarly, every faculty who comes and teaches, they have like a strong industry background in that part of the industry, right? So then, I mean, after the course is finished, there's a dedicated placement support team who actually works with you in your profiling, LinkedIn building, your LinkedIn profiling, and then accordingly they will basis your profile, they will arrange interview calls and support you on the placements and all that, right? So the industry network is pretty strong. We all the founders, we come from a quant background. I mean, and have been working in the quant modeling space for quite some time, so that connect is there. There's a dedicated team which regularly connects with the industry, particularly the HRs, for the supporting the job system or jobs also the students. There then, of course, the students and the alumni of the last 15 years, a lot of themselves actually are like in the leading positions in the industry now, and they also actually, I mean, as one of our pillars in connecting to the industry, right? And then, of course, the faculties, as I said, they're all leaders from the industry themselves. I mean, all this, like said that, I mean, industry connect is pretty strong, and that is all. This is definitely a support you get when you join our courses, right? So companies that you can target, of course, are hedge funds like Renaissance Technologies, DSO, Citadel, Millennium, investment banks like Goldman Sachs, Morgan Stanley, Deutsche Bank, commercial banks like JP Morgan, Citibank, Nomura, stock exchanges, consulting firms, EY, Deloitte, and PwC. Yes, the consulting firms also has been recruiting heavily in the last maybe 5-6 years in the quant and risk advisory departments. Yes, even MNC IT companies like Accenture, Cognizant, TCS, and all these companies as well. And these are the profiles. I mean, since we have already overstood the time, so essentially I'm not going deep into this, but yes, these are areas where we can help you out. This is a very indicative small list of people who have been working. I mean, practically everybody working in the quant and risk management areas. We have a good amount of connect. So this is like just a small indicative list. And yes, as a part of our endeavor to promote the quant finance field in India, so we have been working with all the leading educational institutions. And again, a small indicative list where actually we regularly conduct a lot of events to promote this field. I mean, this is again a very small indicative list. Right. Anybody interested in discussing anything more in detail on any of the topics? Any questions, queries, or like anybody wants to explore any of the courses? This is our contact, and I mean, you can connect with us on, go to our website, iiqf.org. You can connect with us on these numbers, and you can email us to info@iiqf.org. Right. All right, so now let's quickly go to the questions that has been put up, right? So I'll be collating the questions for you, Neha, and then I'll request you to answer them, right?
Sure, Nitish.
Okay. So first question is from Tanumay Hazra, and of course this has been, you might have already mentioned this, but maybe like again, if you want to add anything more on his question. So first question is, so Basel 3, 1 and Basel 4 are they same? And his follow-up question is, okay, follow-up question is on actually a part of the explanation that he was giving. He mentioned that we need to multiply off-balance sheet exposure with CCF. That is also a question. So these are two questions from Tanumay. First part is Basel 3, 1 and Basel 4 are they same? Which you have already mentioned. Want to add anything?
Yes, so Basel IV is a very informal term, but more commonly used because the reforms or the changes are so much. So technically, it should have been a Basel IV, but Basel stuck
Right.
with 3.1.
Yeah. Correct. So anyway, Tanumay, I think that part has been discussed during the session as well. So his next question is like again, do we need to multiply off-balance sheet exposure with CCF? I think this is also
Yes.
something touched upon, but again, if you want to add anything.
Yes, so essentially CCF is used to indicate the future probability of how much of this off-balance sheet exposure will actually be an actual loan on which the RWA should be computed. Okay, so basically it is reflecting a future, the credit conversion. It's a credit conversion factor which is reflecting the credit conversion probability. Okay, so it is applicable only for off-balance sheet exposures, and off-balance sheet exposures are multiplied with CCF to compute the EAD.
Correct.
Okay.
Yes, I hope that answers your question, Tanumay. Right. So next question is from Ashish, and he has asked, is there any Basel paper which explains the changes or oblique difference between Basel 3 and Basel 4?
Is there any? Okay, so for the purpose of my presentation, I had referred to Basel papers only. I don't remember the paper name offhand. Do you want me to add it to the slides?
Oh, yeah, that would be great actually, if
Can
it
you
can
do
be.
that? Yes. So I'll add those to the slides, but they're all from the BIS site only.
Sure, sure. But again, if you can add it for quick reference, that would be great.
Yeah.
Right, Ashish. So, I mean, we will add that to the presentation. The presentation will be shared in the LMS later on, so you can log in and you can get the presentation from. You can see the presentation from there, right? So we'll add it there. All right. So going to the next question. It's from Sikhar Kaushik, and he has asked, ma'am, could you please elaborate on the whole loan and split approach in real estate?
So
Do you want me to make you the presenter again? Do you want to refer to any of your slides?
actually, no, on this one, because I saw, see, the concept that we generally use for very practical purpose is the whole loan concept. That means we analyze based on the exposure itself. The split
Yes.
approach was something that I came across only when I was doing the papers where I took the risk weight screenshot from. Okay, but I'll take that as a question. If I can try and add, maybe I'll add a line to the presentation then on this. Yeah,
Sure.
apologies for that. But more commonly used, or what we use, is the exposure based or the loan based approach itself.
No, no, absolutely, absolutely. No, no, no problem. I mean, yeah, of course. I mean, we all work in certain areas, and then I mean, it's not possible to know everything. So that's absolutely okay, Neha. So you can add a line that in your presentation. So
Sure.
Sekhar, hope that's fine. Right. So the next question is from Chaitanya, and he has asked, are cumulative probabilities of a historical data sample set of borrowers taken into consideration and used to forecast future default ratios using statistical methods such as regression analysis and ANOVA? Would you like to answer that question?
Can I say no to that? So, okay, this is more on the PD modeling, the IRB part, correct? That
Correct.
we are talking about here, right? So, how the
Correct.
actual PD is being derived, okay. I am not into the modeling part, so I wouldn't know the exact methods that are being used by companies actually, by banks
That's
actually, to generate the PD models. The ones that we commonly use in FRM, we use the credit scores to identify the PDs. Those are
correct.
the ones that yes, I am familiar with. I am not familiar with ANIBA model actually.
That's perfectly fine. So Chaitanya, what we'll do is we'll connect you to our other experts in credit risk on that, and personally they will take up that point and then discuss with you. That's absolutely fine.
Thanks, Nitish.
All right. So Adi has a question. So he has asked, actually there are two questions. He has said that please help me understand the capital flooring with an example. And second follow-up question is how to understand off balance sheet and CCF part. So yeah, I mean, do you want to add anything on those?
Capital floor. So I'd like to understand a bit more on the question because I on both actually because those are the examples that are actually given in the slides. So what is it that we would want to clarify? Maybe I can just do a screen share or
Yes,
on pointing out to those.
yeah. Yes, I'll make you the presenter once more. So please share your screen.
Okay, can see my screen?
Yeah, it is there.
Sure. So the example for output floor. Okay, what is output floor? When we say output floor, it is essentially we total up the RWA across each of the areas: credit risk, market risk, and operational risk. Okay, we compute using the nominated approach. What is the total RWA? And we compute using the standardized approach using the again, what is the total RWA? Okay, the standardized approach, we further multiply it with a factor which has been provided by BCBS. So the factors have been provided, let's say, in the slide here. So which we are saying that say we are in 2025, 2024, the output floor to be used is 60%. 2025, the output floor factor to be used is 65%. Okay. So basically, out of this total standardized approach that we computed of 760, I assumed a factor of 72.5, thinking that I'm in 2027 already. Okay. So I've used this factor of 72.5 and I've gotten what is my RWA when I use the standardized approach. Then I will next step is I will compare both these RWAs, your 551 and your 260. The higher of the two is to be considered as my denominator in my capital adequacy ratio. Okay, I hope that answers.
Yes, I hope Adi, I mean, that answers your question. I mean, if you have any follow-ups, you can, of course, you can type in and we'll take up after taking the other questions. Right? Okay. So does that answer both of the questions that Adi had?
That was only on output floor, but CCF I've covered earlier. So maybe if we can detail on what exactly is the question. Then, but just an example, if your CCF is say 10%, like we saw in this example, my undrawn or my off-balance sheet part of the exposure is 90,000, and my CCF for as part of Basel IV is now 10% for a credit card limit. Okay, so then I'll take this 10%, multiply it with the off-balance sheet portion, which is 90,000, to arrive at what is my EAD. The EAD in this case would be 9,000. Okay.
Yes. So Adi, I hope that answers your questions. And if you have a follow-up, please feel free to mention, and we would take up post we take the other questions. Right. So next question is again from Tanumai, and he has asked, what is the difference between input floor and output floor for Basel IV?
Okay. So output floor is the final RWA. Okay, so how do I compute my RWA? If it is standardized approach, I have the EAD and I multiply it by the risk weight. If it is the nominated approach, I have the PD, LGD, EAD, K factor, etc. And I get my RWA. Okay, so RWA is essentially an output. And then we are flooring the output. So that's why this is an output floor. Okay, RWA is the end result. Okay, and then out of the two results that we got, I am taking the higher one. So it is an output floor. Okay, this output is used directly in the next part, which is the capital adequacy ratio. Now, what is an input floor? An input floor, like I said, when I gave the example of input floor or IRB, I was referring to IRB. To compute RWA, you need these as inputs: PD, LGD, EAD, correct? Your PD into LGD into EAD, you have your expected loss formula. Your expected loss, your unexpected loss are used to compute the RWA of an exposure. Okay, so this is nothing but the input. Okay, so RWA is the output, so the flooring on the output is output floor. PD is an input, so the floor on the input is an input floor. Okay, input to the formula, output of a formula.
Correct. Yeah,
Okay, I hope
absolutely.
this explains.
Yeah, I hope that explains, Tanumay. Again, if you have a follow-up, please feel free to type in. Next question is from Mahesh, and he has asked, is this factor of 72.5% used under SA a fixed value or a variable oblique calculated value?
Okay, so I'll come back to this slide here where I'm saying these output floor calibrations of this 55, 60, 65, 70, 72.5 have been provided by the BCBS.
The slide actually is fixed actually. I mean, I don't see that slide. It's an
Uh,
out slide is an
it's,
output flow.
and you see the timeline, implementation timeline.
No, no.
Okay, let me stop and start the screen
Yes,
share.
please.
Okay, can see my slide?
Yeah, absolutely.
So basically the numbers that we see here, the 55%, the 60%, the 65%, all of these are fixed calibrated numbers based on every year. Okay, so if we are in 2023, the output floor to be used is 55%. This is provided by the BCBS. If we are in 2024, the output floor to be used is 60%. Okay, and the BCBS does not tell us what is the rationale behind using these numbers. So, like they have never told us why it is 8% that is your capital adequacy ratio, and why not 10% or 15% or 30%? Why 8% is the capital adequacy ratio? In the similar way, they have not told us why it has calibrated numbers the way it has. Obviously, even they might be doing some studies and coming up with the numbers, but those details are not published.
Right. Right. Yeah. So I hope that answers your question. Right. So next question is from Abhishek, and he has asked, does RWA increase pose a threat to liquidity crisis? Additionally, does this cater to unsecured lending, oblique NPAs in banks or NBFCs tuned banks?
Okay, the RWA increase is okay. Basically, an increase in RWA is going to increase your capital requirement, correct? Why? Because we are saying because we are holding riskier assets. Obviously, if as a bank I choose to invest or I choose to lend only to risky assets, okay, which is why my RWA is increasing. Okay, then obviously I face the problem if I have not managed it with enough capital, if I have not managed it with enough provisions. Okay, then though I'm looking at good profitability, but I'm also looking at higher risk. Okay, so the whole point of doing the RWA assessment and trying to keep a minimum capital requirement is to ensure that if we are holding too risky capital, too risky assets, a lot of our portfolio is fully made up of riskier assets, then we should have enough capital so that we can. Because it's a risky asset, it's going to be very variable. Like we saw in subprime crisis, what happened to loans which were given to the subprime customer, which are the riskier customer for a bank, right? They defaulted on those loans. Okay, so we should expect that yes, the defaults will happen. There will be an increase in your NPS because we are holding riskier assets. Okay, I hope I got the question.
Yeah, I think so. I hope that answers your question, Abhishek. Again, if you have a follow-up, please feel free to type in. And in the meantime, let's go to the next question from Rishikesh. And he has mentioned what asset classes, oblique geographies that will continue to use internal models, considering the fact that regulators have reduced the incentives on internal models versus standardized approach.
Okay, we expect the internal models will be phased out because finally, what regulators are asking is that you have to, look at, see, it has to be the higher of the two, right? So it has to be either a factor of the standardized approach or the nominated approach, which uses internal models, correct? And finally, we are saying that at the minimum, I have to report the factor of the standardized approach. So then banks will no longer compute nominated approach. Okay. Nominated approach is only valid when you actually can do some capital savings. Okay.
Right.
Yeah. So I did not get a chance. I forgot to show it earlier. I'd like to show this dashboard because the other question is on the timelines. Okay. Though I don't see, obviously the internal approach would no longer be required for your minimum, your pillar one reporting purpose. It might be used for
Are you showing
ICAP, etc.
are you
Hmm.
showing the dashboard actually?
Yes. Yes. I'm sharing a screen. Can you see?
Actually, the screen is stuck at the output floor. So, I
Okay.
mean,
Let me stop sharing and I'll start again. Okay. Fine. This is a dashboard which is published by BIS. Again, I'm on the BIS site, and you will see the date of this is as of 30th September. And this is actually showing a it is actually giving you a good idea as to what is the status of the Basel III standards adoption. Okay. So let's look at output floor, and let's see India. Oops. So if you see India output floor, there is an NA on that particular dashboard. Okay, so let me take my cursor there. So you will see for India, it is saying output floor is not applicable. Why is it not applicable for India? Okay, it is not applicable for India because India, in the first place, RBI has never mandated the use of internal models for computation of our RWAs. We are always using standardized approach. Because we are always using standardized approach, the output floor implementation for India is actually NA. Okay. Similarly, the IRB changes that we mentioned earlier, they are NA for India because we have never been using it. Okay, so NA means that we have not used it, so we don't need to make changes. Okay. However, for your credit risk essay approach, we are at 1. What does this one say? This one say that the adoption has not yet started. The adoption of using revised standardized approach for credit risk has not yet been started in India. India has not yet even released a draft regulation based on which they can do the industry feedback sessions and then publish a final regulation. Okay.
right. Right. I hope that explains your point, question, Rishikesh. Okay. So now, I mean, we are already almost 20 minutes past time. So we'll quickly take up like 2, 3 more questions and then we will wrap up the session. Next question is from Sunil Natarajan, and he has asked, how do we calculate CAR under this approach for stress testing exercise? Would you like to take up that question?
Okay, so for stress testing is basically part of your pillar 2. Our focus for today has been pillar 1. Okay, so for capital adequacy ratio is computed as part of pillar 1. For as part of pillar 2, you have ICAP. Okay, which is for computing the related, so which is nothing but stressing the numbers nowadays based on climate scenarios as well, to compute what would be your RWA and then see what is the CAR based on the stressed information.
Okay. Correct. All right. So I hope that answers your question, Sunil. Any follow-up, you can let us know. Next question is from Parthi. He has asked, like, when was LRRBB adopted by the banks? Would you like to take that up?
Sorry, which one?
He has mentioned LRRBB.
IRRBB, interest rate risk in banking book. Is that the question? So
Possible. It's
let's
like
see
mix
if we can. I
of
think
cap and party can clarify. Otherwise, it can be IRRBB as well, because everything is in small cap, and then if it is like a large cap, possibly IRRBB also possible. Yeah,
I
yeah,
think the
it's
answer would be the same only. I think for any Basel III reforms, the dashboard that I had shown earlier, I'm still sharing it on my screen. You can see IRRBB by countries when it is going to be implemented.
that's correct. So yeah, it would be IRRBB only. I mean, my apologies.
No
Yeah,
problem.
it was mentioned as LRRBB, but it was maybe his typo. But nonetheless, it's yeah, it definitely would be IRRBB, because LRRBB doesn't make sense. Anyway, right. So now, like, quickly going into Saurabh's question. So he has asked, is Basel IV, is it already widely applicable in the financial institutions?
Again, status is here on the dashboard. I have, sorry, by countries. So, okay. So what is happening, just to give I covered on this point, but let me just reiterate it again. Basel guidelines are the initial phase. These are still guidelines. For this to be applied for all banks in all jurisdictions, these guidelines need to be adopted by the local regulator. In our case, it is the RBI. They need to adopt these guidelines. The bill has to be passed in the parliament. It has to be a legal requirement, and then it means that, oh yes, the country has adopted a particular regulation, and we report it as per that. Okay, so mostly you will see, okay, in terms of my experience, because I'm working in the Southeast Asian region right now, I know Singapore is in the forefront of implementing these. It is not yet implemented, and other countries like Malaysia, China, Hong Kong, they are still in process. Okay, but if we look at something like EU or US, I think they have already started with a lot of the implementation. They're probably towards the tail end.
Right. Right. So I hope that answers your question. Next question is quickly a couple of questions from Sanjay actually. So what are some of the risk balancing approaches, especially when banks are holding riskier assets? And a follow-up question, how does risk transfer and securitization happen for riskier assets under Basel III or Basel IV?
Sorry, Nitish, can you just first repeat the first question only?
Yeah,
I
yeah,
didn't get
sure.
both the questions. Yeah.
I'll take it one by one. Maybe since
Okay.
this is a link I tried to read together, but anyway, I'll take it one by one. So first question is, what are some of the risk balancing approaches, especially when banks are holding riskier assets?
Okay. So, what are the risk balancing approaches? So, uh, if you are holding riskier assets, then the obvious approach is reducing the exposure to riskier assets. Okay, banks are not, okay, banks are not supposed to, we are supposed to be profitable, banks are supposed to make profit, but then, there is a lot of dependency on a bank to work because it impacts the overall financial ecosystem and the economic and the larger economy and the world economy as well. Okay, so banks really are not standalone. So the whole point of these reforms is so that banks reduce the riskiness of their asset classes. Okay, so the ideal this is either you reduce the exposure to riskier asset class, or second you increase the capital. So as part of Basel III reforms, you identify that previously you would probably not consider an asset class as risky, but now because of Basel III reforms, they are being considered, you can see that they are being considered as more risky because they're now having the larger part of the pie of the RWA pie. So hence they are more risky, right? So you can identify that and then you can see how you want to manage it. Okay, do you want to ensure that you have more than enough capital for such type of asset classes, or do you want to ensure that you are changing your business model in terms of trying to identify profitable avenues which have lesser risk. Okay, so more strategic decisioning needs to be done on this part. The good part is that we have the data now. So much of information is available now. We need to slice and dice through that to ensure we come to a good decision.
Absolutely.
Okay.
So
The
he has a
second part, yeah.
follow-up question. How does risk transfer and securitization happen for riskier assets under Basel III/Basel IV?
How
Do you
does
want?
risk transfer or securitization for securitizations happen? Is it? So I'm not really sure about the risk transfer part, but if you're talking about risk weight, the risk weight, the RWA computation for securitization for Basel IV, actually this has also been part of the Basel III or Basel IV changes, that for securitization, there are stricter rules. Okay. Now, just to give a background, it might not really answer the question, but just sharing that securitization, one of the main causes of global financial crisis as well. Why? Because there was the liquidity in the securitization market suddenly evaporated because people realized that there is a securitization. We have been rating it as highly rating it as AA, AAA, but it is all the underlying which is actually making up the securitization are my subprime loans. Okay, so this became very obvious that because banks were at a loss as to how these securitization were being rated so highly when the underlying is actually a very poor quality collateral. Okay, or the underlying on based on which the entire securitization has been made is actually very poor quality. Okay, so because to address these shortages, now, if a bank is entering into a securitization, whether it's as an investor, whether it is as an SPV, himself making the securitization and selling it off, they have to ensure there is enough transparency. So there are a lot of factors that are introduced for measuring securitization as part of the Basel reforms, like the seniority, the underlying collateral, the maturity, the attachment, detachment, tranche, etc. So a lot of technicalities were introduced, and if these are not available, so various methods have also been given to compute securitization. There is the standardized approach, then there is an ERBA and an IRBA, and if there is no information available about the securitization, the RWA attached to the securitization is 1250%. 1250% of the exposure related to a securitization will be considered as my RWA. Okay. So just showing that if you have a securitization with not enough information, it is to be considered as highly, highly risky.
Right, absolutely. Okay. So last question actually we would be taking up. That answers your question, Sanjay. And I mean, okay. So Adi has a follow-up question. So RWA is calculated on the base of ratings for each category, or is it based on internal modeling?
If it is the standardized approach, then it is based on the risk weight given by the regulator. If we are using the nominated approach, then it is based on the internal model, which is what is the PD, EAD, LGD derived after using the internal models.
Yeah, absolutely.
Okay.
Absolutely. There's a follow-up question Adi has, a little interesting question. So
Mhm.
how do you see Basel IV for job opportunities? Is it going to be more like IFRS 9 or less?
Okay, so I don't know the comparison with IFRS 9, but for the last 10 years, Basel has been keeping me employed and happy. So, so hoping for the same.
Yeah, that's correct. So essentially, like again, Adi, Basel is, I mean, a very important aspect for all bankers, given like the stress on this on the international regulators and then of course on each country regulators. So I mean anybody specializing in Basel can hope to be in continued employment for quite some time, right? So that's definitely an
But
opportunity.
maybe I'll just add on, Nitish, because I think what was the purpose behind the question was, okay, what is the next upcoming that is it going continuing to be Basel or is it something else? So
Right.
maybe I'll just say there is a lot of focus on climate risk. I think
Correct.
IIQF is also focusing on that. So that is
Yes, please.
something that we need to watch out for.
Absolutely. Like in climate risk is very hot, and the emphasis on that is increasing rapidly. So yes, IIQF will be focusing on general quantity finance and risk management courses, as well as we would have specialized courses on climate risk going forward. So yeah, I mean that's one area definitely one can focus on for the future. All right. So now I mean maybe can we take two more questions, Neha? There are a few more, but again most of them are
Um,
repeated.
okay, maybe two quick questions then.
Two quick questions. Yes. One from Saurabh again. What happens to priority banking sector? They are obviously riskier assets. Waiver rates are high. So, I mean, he wants to understand what will happen to them.
Priority banking. Can I ask what do you mean by priority banking? Because if I get it correct, priority banking, like I had an HDFC priority banking account where they're actually saying that, I am a salaried customer. I ensure that I have good deposit with the bank at any given point in time. My assets are actually not risky. If I take a loan from HDFC, they would already know because I'm a salaried account holder with HDFC that good credit ratings overall. So I don't quite agree with the question per se.
Correct. And I mean, maybe like again, a general way to answer that is if the priority banking he is mentioning has more riskier assets, then actually they would have to adhere to the provisions, may have to increase capital or like maintain more reserves.
Yes,
Same
yes,
simple.
that's correct. Yeah.
So I mean, if I mean that goes for any kind of lending actually. If your priority banking division is something which actually is going into more riskier assets, then you have to adhere to the guidelines. It's as simple as that, probably. Yeah, but again, whether to increase or decrease that kind of risky banking or I mean risky assets is something the bank will decide based on considering a lot of things. I mean, how much capital that they have. I mean, what kind of business that they are banking. So these are like decisions.
That's
Actually, it's
true.
not straightforward to answer, right? It depends on like the overall philosophy of each bank actually. I mean, if they're going for riskier things, then they will have to adhere to more, guidelines. So anyway, last question from Adi, and he has asked, who can go for nominal approach and standardized approach? I believe this is something we have touched upon, but
Hmm.
anything you wish to add on this?
Sure. So standardized is the default approach. If you want to go for nominated, so when I say nominated approach, it can be whatever the bank is using. It can either be standardized only, because that's the default approach to use for all the banks, or it can be a mix of all three: AIRB, which is your advanced internal rating based approach, IRB, foundation IRB, and standardized approach. Okay, so for using IRB for computing RWA, we need to get regulatory approval. Okay, so we need to present our models to the regulators. We need to give them evidence that yes, we have backtested these models, and they are giving consistent results, and we think they represent our actual business. They represent our actual business and risk worthiness. So if we give all this information to the regulators, and if they are satisfied, then they will approve, and then only we can use a particular AIRB or FIRB approach for a particular portfolio for which we have received approval for. Okay. So if I want to add on more portfolios to use AIRB, then I'll have to go back to the regulator, get the approval from them for these new portfolios, and then only I'll be able to use it.
Yeah, absolutely. So, I mean, okay. So now there's no more questions. So one quick query from Farzana, which I'll actually address, and then we'll wrap up the session. So Farzana has, okay, so you have missed the first part of the session, and she wants to know when is the next session for Basel IV. So essentially, like, Farzana, first thing is like, again, we generally don't repeat topics in quick succession, right? So, I mean, we might not have another Basel IV session immediately, right? However, said that, again, I mean, we would be sharing the recording of the session with all the participants, right? So, I mean, you may go through the recordings for the part that you might have missed. In fact, you can go through the recording of the entire session. Later on, it will be shared in the LMS platform. So, I mean, from where you have actually logged into the session, joined the session, the same there would be a place to view the recording in the same LMS under this webinar. Right, so we'll be sharing this for you, so essentially for your future reference. Okay, so with that, I think let's like wrap up the session. First of all, again, it has been very engrossing, and we have actually extended by more than half an hour actually. But I mean, the questions were interesting, and thanks Neha once again, first of all, for a great session, and more importantly, patiently answering all these questions. So thank you so much.
Hey, thanks, Nitish. It has been a pleasure.
Pleasure as well. Thanks for joining, and so much. Thanks so much, and so also to all the participants as well. Thank you so much for joining on a weekend, Saturday, and it was lovely having you all. So, as part of our webinar series, deep dive with IIQF experts, every month we have one or two webinars on important topics. So. Please keep following us on our website, social media pages, and other links. We'll also keep you intimated over emails as well on the next set of webinars. So keep following us, keep joining us on all these webinars, which we keep on conducting. And thanks. So with that, I will wrap the session for the day. Thank you.
Thank you.
Thank you, Neha. Thanks.